Did you know there's a rare signal in the silver market, that S screaming a warning about our financial system? It's only happened twice before in the last 50 years, and both times it was the prelude to some serious economic turbulence. Today, we're going to unpack what this signal is, why it's flashing red right now, and what it could mean for all of us. This isn't just about precious metals. It's a story about the health of the entire global economy. So let's talk about silver. Most people think of it as just a less expensive version of gold, but it has a unique dual personality that makes it incredibly important. On one hand, it's a monetary metal, a store of value that people have trusted for thousands of years. On the other hand, it's a critical industrial metal. Your phone, your car, solar panels, medical equipment, they all need silver. This means silver's price is influenced by both investment demand and industrial demand, making it a fascinating barometer for the economy. Now, for the main event, the signal. It's all about something called backwardation. Normally, the price of silver for future delivery is higher than the current spot price. This makes sense, right? It accounts for storage costs, insurance, and the time value of money. This situation is called contango. But every once in a while, this flips. The spot price, the price for immediate delivery, becomes higher than the future price. This is backwardation, and it's a huge deal. Why? Because it signals an extreme physical shortage. It means buyers are so desperate for silver right now that they are willing to pay a premium to get their hands on it immediately, rather than waiting. They're essentially saying, I don't care about the future price, I need the physical metal now. This level of urgency points to a major breakdown in the supply chain and a loss of confidence in the paper market's ability to deliver. This exact scenario has played out twice before with dramatic consequences. The first time was in the late 1970s, leading up to the Hunt brothers' attempt to corner the silver market and the subsequent economic chaos, including soaring inflation and interest rates. The second time was in 2008, right before the global financial crisis. In both cases, sustained backwardation in silver acted like a canary in a coal mine, signaling that something was fundamentally wrong with the financial system. It was a symptom of a much larger disease. And guess what? It's happening again. Right now, we are witnessing persistent backwardation in the silver market. Major exchanges are reporting critically low inventories. Big buyers, including industrial users, and even nations, are scrambling to secure physical silver, draining available supplies at an alarming rate. This isn't a one-day fluke. It's a sustained trend that mirrors the patterns we saw before major financial disruptions. So, what does this mean for you? It's a powerful warning that the stability we often take for granted might be more fragile than it appears. When the market for a metal as fundamental as silver starts to break, it suggests that the foundations of the broader financial system could be cracking too. It's a signal of distrust in paper assets and a flight to tangible physical value. This isn't about predicting the exact day a crisis will hit. It's about recognizing a historical pattern that is repeating itself in real time. The demand for physical silver is overwhelming the paper-based supply system, and history shows us that's a symptom of deep-seated economic problems. Whether it's inflation, a debt crisis, or a currency reset, the silver market is telling us to be prepared. It's a fascinating and, frankly, a slightly alarming story unfolding right before our eyes. Keep an eye on this space, because what happens in the silver market rarely stays in the silver market. It is a wake-up call for everyone to pay closer attention to the health of our financial world, the silver market. You might think of silver as just for jewelry or old coins, but it's a huge global market with some fascinating mechanics. So how does it all actually work? Let's break it down. First off, let's talk about supply. Where does all this silver come from? About 80% of the world's silver is a byproduct of mining for other metals like copper, lead, and zinc. This means silver's supply isn't just about how much we want to dig up. It's tied to the demand for these other industrial metals. The remaining 20% comes from primary silver mines and, increasingly, from recycling. Think old electronics, photographic film, and silverware. This recycling component is crucial because it adds a flexible source of supply that can respond more quickly to price changes than mining can. Now, let's flip to the demand side. This is where things get really interesting. Silver's demand is split into a few key areas. The biggest one is industrial use. Because silver is the most electrically conductive and thermally conductive metal on the planet, it's essential in electronics, solar panels, and even medical equipment. The green energy transition, especially the boom in solar energy, is a massive driver for industrial silver demand. Then there's investment demand. This is when people buy silver bars, coins, or exchange-traded funds known as ETFs as a store of value or a hedge against inflation. Unlike industrial demand, which is pretty steady, investment demand can be very volatile. It often spikes during times of economic uncertainty. When people get nervous about the stock market or currencies, they often rush to precious metals like gold and silver, pushing up the price. Finally, we have jewelry and silverware. While this is a more traditional use, it still makes up a significant portion of demand. It's often influenced by cultural trends and economic prosperity, particularly in large markets like India. So, how is the price actually set? The global benchmark for silver prices is determined on exchanges like the COMEX in New York and the London Bullion Market Association, or LBMA. Here, large financial institutions, mining companies, and refiners trade massive contracts for physical silver and silver futures. A futures contract is an agreement to buy or sell silver at a predetermined price on a future date. The trading of these contracts creates the spot price of silver that we see quoted every day. It's a constant tug of war. On one side, you have the physical supply from mines and recycling. On the other, you have the diverse demand from industries, investors, and jewelry makers. All this activity is happening on global exchanges, with massive amounts of money flowing in and out, creating the price. What's fascinating is how these different factors interact. For example, a slowdown in the global economy might reduce industrial demand, but could simultaneously increase investment demand if people are seeking a safe haven for their money. Understanding the silver market is all about watching these different forces. It's not just a precious metal, it's a critical industrial commodity. Its dual nature is what makes it so unique and at times so unpredictable. From the copper mines of Chile to the solar farms in China and the trading floors of New York, the silver market is a truly global and interconnected system. I hope this gives you a clearer picture of how the silver market works. Now, you might think of silver as just gold's less glamorous sibling, but historically, silver has been a powerful canary in the coal mine for the global economy. When silver starts making big moves, it often sends a powerful message, and right now, that message is getting louder. Let's explore the major consequences that could unfold if silver's current signals hold true. First, let's talk about the most direct consequence, a potential revaluation against gold. For centuries, the gold to silver ratio, which is simply how many ounces of silver it takes to buy 1 ounce of gold, has hovered around 15 to 1. Today, that ratio is dramatically higher, often sitting between 70 to 1 and 90 to 1, a signal. From silver, could mean this historic ratio starts to normalize. If silver's price were to surge to close that gap, we're not just talking about a small jump. It would represent a massive repricing of a key monetary metal. For investors, this could mean that silver outperforms gold, potentially by a huge margin. It's a shift that would rewrite the playbook for precious metals investing, forcing everyone to pay much closer attention to what was once considered a secondary asset. The second major consequence ripples out into the industrial world. Unlike gold, which is primarily a monetary asset, over half of all silver demand comes from industrial applications. It's in your phone, your solar panels, your car, and in countless medical devices. It's an indispensable technological metal. So, a strong upward signal in silver's price isn't just a financial event, it's an industrial one. A sustained price increase would raise manufacturing costs across the board. Companies that rely heavily on silver, especially in the green energy and electronics sectors, would face a tough choice. Absorb the higher costs and shrink their profit margins, or pass those costs onto consumers, leading to higher prices for everyday goods. This is a direct link between a financial market signal and your wallet. Third, and perhaps most importantly, a strong silver signal is often interpreted as a vote of no confidence in fiat currencies, like the US dollar. Throughout history, when people lose faith in paper money due to inflation or economic instability, they flock to tangible assets like gold and silver. Because the silver market is much smaller than the gold market, even a small shift in investor demand can cause a dramatic price spike. If we see a major, sustained rally in silver, it could be one of the clearest indicators that a broader flight from currency is underway. This isn't just about investors hedging their bets. It's a sign of a deep-seated concern about the long-term purchasing power of money. This could trigger wider market volatility as people question the stability of the entire financial system. It's a classic safe haven move, but on a scale that could have profound effects. Finally, a sustained silver rally would have a significant psychological impact. For decades, the financial system has been dominated by stocks, bonds, and complex derivatives. A return to prominence for a physical, historical form of money like silver would represent a major paradigm shift. It would validate the arguments of those who have been warning about currency debasement and unsustainable debt levels for years. This could lead to a massive flow of capital, not just into silver, but into the entire commodities and hard assets sector. It would force mainstream financial media and institutional investors, who have often dismissed silver, to take it seriously. This psychological shift could create a self-reinforcing cycle, where rising prices attract more attention, which in turn drives prices even higher, changing market dynamics for years to come. So when you see silver making headlines, remember it's more than just a commodities price fluctuating. It's a signal with potentially huge consequences for the gold market, for industrial costs, for the value of our currencies, and for the very psychology of the market. It's a story about history, technology, and trust, all wrapped up in one shiny metal. At this stage, the silver signal should no longer be interpreted as an abstract market anomaly. Historically, this is the point at which it becomes a strategic consideration. The question is no longer whether the signal is real, but how decision makers respond to it. The distinction between those who adapt and those who delay has, in past cycles, determined outcomes. This moment does not demand prediction. It demands preparation. Silver's behavior is not offering a timetable or a guaranteed sequence of events. It is highlighting a probability shift. When probabilities change, rational actors adjust exposure. Waiting for certainty is not prudence, it is risk concentration. One of the most consistent mistakes made in prior episodes was treating this phase as optional. Market participants assumed that if stress was genuine, it would be visible everywhere at once. They expected confirmation from equity indices, policy statements, or headline indicators. By the time such confirmation appeared, flexibility had already diminished. Balance sheets were committed. Liquidity had become expensive. Strategic actors approached the situation differently. They recognized that systems under strain do not fail symmetrically. Some assets reprice first. Some markets freeze before others. The goal was not to exit everything, but to ensure that survival did not depend on uninterrupted stability. This reframes the role of silver. It is not a speculative vehicle in this context. It is a diagnostic tool. It reflects where leverage is excessive and where confidence is overextended. Ignoring it does not eliminate risk, it obscures it. For entrepreneurs and business operators, the implication is indirect but critical. Businesses fail during stress periods, not because demand disappears overnight, but because assumptions break. Credit lines are withdrawn. Refinancing terms change. Input costs become volatile. Customers delay payments. These are second-order effects, but they arrive quickly once financial conditions tighten. Resilience, therefore, becomes a strategic asset. This includes liquidity buffers, diversified funding sources, and reduced reliance on short-term refinancing. It also includes operational flexibility, the ability to adjust production, pricing, and investment plans without triggering existential risk. Capital allocators face a parallel challenge. Exposure alignment matters more than timing. Portfolios constructed for maximum efficiency under stable conditions become fragile when volatility returns. The silver signal suggests that stability itself is becoming conditional. Another historical lesson is the danger of false comfort from partial protection. Hedging strategies that rely on correlations remaining intact often fail when stress becomes systemic. True optionality comes from balance sheet strength, not complex financial engineering. The strategic error is assuming that the absence of crisis equals safety. In previous cycles, the most dangerous period was not the downturn itself, but the late-stage calm that preceded it. That was when leverage was highest, margins were thinnest, and confidence was least justified. This does not imply imminent collapse. It implies that the margin for error is shrinking. In such environments, small shocks produce outsized effects. Planning must account for this nonlinearity. For decision makers, the appropriate response is measured, not reactive. Reduce dependency on continuous liquidity. Stress test assumptions under adverse conditions. Reevaluate exposures that rely on stable financing or suppressed volatility. None of these actions require dramatic market calls. They require discipline. Silver's signal has historically been ignored precisely because it is inconvenient. It does not align with optimistic narratives. It does not offer easy solutions. It simply indicates that the system is under more strain than is publicly acknowledged. The final part of this analysis will synthesize these elements into a forward-looking framework, one that does not attempt to forecast outcomes, but to navigate uncertainty with intent.